I'm excited to share today my complete oil stock portfolio. Out of the 38 dividend paying stocks that I own, these stocks all pay dividends to me that I can use to pay the bills. 3 of my stocks are oil companies. And if you've been following my channel for a while, I will link in the description below. I've already shared 2 videos on investing in the oil industry. The first video did an overview of all the lessons I've learned over the years investing in oil stocks. The second video shared one of my positions that I own that really broke a lot of the rules that I typically try to follow as an investor, and that stock, by the way, is BP. And today, by popular demand, I have one subscriber in particular who has been reaching out asking me, "Hey Ian, when is part 3 of your oil series going to come out? I've been waiting. I'm really interested in these oil stocks." Well, I'm finally doing that video. And so I'm going to share the other 2 oil stocks that I own today. These are new stocks that I have never shared on my channel before. And the first one is Chevron, ticker symbol CVX. And the second one is Royal Dutch Shell, ticker symbol RDSA. So let's get started. It's going to be a fun day of dividend stock investing. So, welcome to the video, everyone. I want to do a quick overview of the 3 oil stocks that I own. I want to share the reasons that I own each particular oil stock, and at a meta level frame how I think about investing in oil companies in my personal stock portfolio. At a high level, before I even get into the oil stocks, one point that is so important is unfortunately this industry is prone to disaster. Unfortunately, there was a tragic event with one of my holdings, BP. This is before I owned the stock actually, but there was an oil spill. It was an oil issue with the Deepwater Horizon rig. And so when these disasters tend to strike, it can create obviously a lot of trouble, a lot of havoc out there. They're very tragic, unfortunate events. But also from a stock investing standpoint, they can create a lot of risk. And so overall, oil stocks actually are not a huge percentage of my total portfolio. By dollar amount, they represent 5.5% of my portfolio. But of the 5.5% that I have allocated for oil stocks, do I put them all in one oil stock? No, that would be too much concentration of risk in my personal opinion. This is an industry that totally warrants intra-industry diversification, and that's why I have spread my risk across 3 oil stocks. And so we'll get into all 3 of them today. So first one is Chevron. This is actually the first oil stock that I purchased, and when I look at things in retrospect right now, if I could only own one oil stock, if you just told me, "Hey Ian, you can't diversify, you're not allowed to diversify." Like I said, I like to diversify in this industry because it is prone to some turbulence over the long term. That being said, if someone said, "Ian, you can absolutely not diversify," the one oil stock that I would likely buy and hold forever is Chevron. So this is the first one that I bought. This is my favorite oil stock. We'll get into some of those points in a minute, why I like this company so much. When the price of oil tanked, you may remember from my video, if you have not seen it yet, I'll link in the description below. The price of oil tanked a few years ago. It actually hit a low of $35. This is because OPEC had flooded the market with oil. They had upped their production levels, and the reason that they did this is they wanted to fend off competition from some of the United States-based oil fracking companies. And so they drove the price of oil down purposefully to try to push off competition, and the price of oil fell to $35. And this was just a few years ago. And at those prices, obviously the oil companies all tanked in share price. And for me, I like to, being that oil is very cyclical, being that it's an industry that has its ups and downs, being it's an industry that carries a lot of risk, I personally have chosen to focus on the oil super majors. So that's what these companies are that I own. They're considered super majors. They're large, diversified oil companies, really large mega cap oil companies. Anyways, the price of oil has now recovered. This is Brent crude as of today. We're in October of 2018. It's at $75. So the price of oil has certainly recovered from its low. And what I've learned over the course of the years investing in oil is it is just so highly cyclical. And I'm going to show that as an example through my own stock portfolio right now and the various purchase prices that I've experienced over time. So my best purchase price on Chevron in September of 2015 was $76.62. By contrast, the worst purchase price that I had, this is when I paid a lot more for Chevron in years past, I bought it for $126.09. This was in May of 2013. Right now, the price of Chevron is $110. And so obviously over the years, the stock price has fluctuated, and it's mainly been because the price of oil has fluctuated so much. Oil is a commodity. At the end of the day, it's a commodity. Unlike some of the consumer non-cyclical companies that I own, there's not really a competitive moat in terms of brand. Maybe there is at the pump. There's some differentiation there. Quite frankly, I like Chevron because I believe, based on their branding and based on wisdom that's been passed to me from one of my childhood friends who is very into cars, that Chevron with Techron, that is the best quality oil or gasoline for one's vehicle. So if one has a vehicle that they cherish, that they want it to last a long time, they take good care of their car like I do. I wash my own car myself. I take great pride in it. I never take it through the car wash because I don't want them to scratch it. I have been led to believe, at least, that Chevron is the best quality gasoline. And so certainly there's some branding at the pump and some differentiation. But at the end of the day, I am a corner case. For most consumers, they're shopping for oil on price, gasoline on price. And so this is a commodity. There's really no competitive moat. And so the stocks go up and down and fluctuate as it pertains to the price of oil. Now, I would say the strongest oil companies, what they've done is they have gotten their cost of production to the lowest possible mark. The lower the cost of production, the lower it costs to extract oil from the earth, the better their competitive moat is. Anyways, you can see here, these are just some wild swings. Really just over 2 years later, it went from 126 down to 76. I bought at both of these points. And in between as well, I bought this stock many times. I've averaged into Chevron over the years, and right now it's at 110. And so right off the bat, one of the lessons I've learned is, look, if I was getting started again, I own no oil stocks. I personally would probably pick up an oil stock here just because I would want representation in my portfolio. I like having representation from most major sectors, and I like having representation from oil. And at 110 versus my price in 2013 of 126, that's a reasonable entry point. And you'll see more in a minute why as a function of the dividend yield. That being said, it's a far cry from $76. And so now that I own oil stocks, they're at 5.5% of the portfolio. I could see oil representing as much as 7%. I don't want it to be much more than 7% of the portfolio. If the price of oil ever goes down, if these stocks correct in a major way again, like Chevron, for example, gets maybe down below $100, it gets into the 80s or 90s, even the 70s, I would add more, and I'd be comfortable bringing my position up a little more. But at current prices, I'm certainly not adding to these stocks other than reinvesting dividends. And the reason for that is the price of oil has recovered quite a bit. And $75 in the scheme of things, that's actually a pretty high point for oil. If you look at the long-term oil chart, it's been all over the place, and 75 is towards the top. And so I just don't know where the price of oil is going to go from here, but I certainly don't want to average in and buy more oil stocks here other than reinvesting dividends. That being said, like I said, if I had no exposure, I'd probably look at it a little bit differently. And the reason being is Chevron's dividend is $4.48 per year. My yield on cost on my best purchase price is a 5.85% and growing, because these guys tend to raise the dividend over time. They had to stall the dividend increases during the oil crisis a few years ago when the price just plummeted, but they did not cut the dividend, and typically these guys raise the dividend over time, and they have a really good track record of that. And so 5.85 yield on cost on my best purchase price, but that is growing. On my worst price, my yield on cost is a 3.55%. So you can see, again, the discrepancy there, how wild these fluctuations are and how they can affect one's yield on cost. The current yield on cost, just for someone literally buying today, is a 4.04%. Because it's 4.04, that's a reasonable starting yield, and that's why I'm saying if I had no exposure to oil, I'd probably pick up some Chevron here, a very small position, have some exposure in my portfolio. And the reason I would do that, hypothetically speaking about my personal way I personally structure my portfolio, is the starting yield's reasonable. It's over 4% and it's growing, and certainly oil is not at an all-time high. It's not over $100. It's at 75. So there's certainly, it's kind of in the middle. It's in the middle of the range, and that's why I like it here. Now, what do I like about Chevron? I like this company because they raise the dividend over time. This is a dividend growth company. It's a company that has raised the dividend over time. It was unfortunate that during the recent oil crisis, the dividend was never cut, but the increases were paused. There were certain points when typically in a normal market, they would have increased their dividend. They decided, hey, I'm not going to increase the dividend. I'm just going to keep it the same until some of this oil price drama blows over and the price of oil gets back to normal ranges. And so, but needless to say, the dividend growth out of all three is looking forward, in my opinion, is the best. Great prospects for dividend growth. And I love companies that grow the dividend because my current yield isn't quite that important. It's really my yield on cost. And I'm looking at yield on cost years out because I'm not using dividends to pay the bills now. If I was using dividends to pay the bills now, some of my decisioning would be different. But because I'm looking at years in the future, I love companies that raise the dividends, and this is one of the great ones that does it in this industry. So what else? Stability and quality. Chevron, out of all three, in my opinion, is a stable company and a quality company. It's a premium name. It's more of a rock-solid company that during turbulent times, it's easier to rest assured that the company is not going to face challenges. And one of the reasons for that I want to point out, which is the third reason I like it, is the lower amount of debt. They have plus or minus $38 billion in debt. In terms of scale, you'll see in a minute that their debt of the three is the lowest. So they have managed their balance sheet really well. They've kept their debt amounts down. They've been smart about it. And that's just something I like about Chevron. They're stable, they're clean, they're rock solid. And that's why I bought them first. That's why I love these guys. It's my favorite oil company. Now, a funny side note, at one point in my history, I actually did own shares in Exxonmobil. I do not own those shares anymore. The reason that I got rid of Exxon, one, it was kind of a smaller position and I didn't intend to add to it. And at one point I had too many stocks. I was up to, I'd say, about 45. Along the way, I cut some of them out. But I kind of look at Chevron and Exxon as the two kind of gold standards of the oil industry. Those are just the two that it's really possible to sleep well at night, even in this environment where oil, in this industry where oil can go up and down quite a bit. Royal Dutch Shell. So I own Royal Dutch Shell. This may be controversial, but I own the A shares. Most people buy the B shares. I bought the A shares. So the B shares are London listed. The A shares are the Dutch, Netherlands listed shares. At the end of the day, both will be comparable in coming years because the tax code is going to be more favorable in the future, as it seems, as my research indicates. Nothing's happened yet, but my understanding is they're going to have a similar tax treaty in the future like the UK and the US do. And so the reason people go to the B shares is because they're UK listed, there's no foreign tax withholding. And so because I own the A shares, there's a foreign tax withholding, but I can claim back the foreign tax withholding on my tax return as a credit. And so for me, because I have to file taxes anyways, I suspect some dividend investors, especially if they live off dividends and they have a lower amount of dividends and they can do arbitrage and live somewhere real cheap, maybe their tax consequences are just so minimal that they don't want to be dealing with foreign tax withholdings and tax credits. But for me, I'm in a position where I definitely have a complex tax return. I've got to do taxes. And so foreign credits for me, foreign tax withholding, it doesn't really bother me because it all comes back anyways through the credit. Anyways, I actually did a video on the tax implications of dividend investing. I'll link in the description below. Kind of not the most exciting topic of all time, but certainly a practical topic that I wanted to share. So check out that video if you want to learn a bit more on these types of topics. But I own the A shares. The other reason I own the A shares is when I was doing my research, and this was years ago, the way this company was structured, the B shares were tied to one side of their business, the A shares were tied to another side of their business. I don't even remember all of the details, but I think it was that the A shares were tied to the actual oil reserves, the actual assets, the real oil that's in the ground, whereas I think the B shares were kind of more tied to the refining side of things and to some of the other logistical side of things. And so the way I looked at it, I tend to look at things from a very conservative standpoint. And when I invest, I want to have, I at least for this one, really wanted to have my hands on the A shares just because I felt more confident about them. I think this is going to be a very controversial topic out there because I know like 99% of dividend investors, they go for the B shares. Anyways, what's funny is in a year or two here, my understanding because of the changes in the tax code, A and B from a tax standpoint will be roughly similar consequences. And so it all kind of works out whichever way one goes, but that's why I own the A shares. Anyways, this is a stock that I first purchased in 2014, and I bought my worst purchase price. Well, actually, I don't know when I first purchased it. But what I wrote down is probably circa 14, maybe somewhere around then. My worst purchase price was right here, though, $71. What's crazy is just 1 year later was my best purchase price in 2015 for $48. Again, this is what the volatility of oil, a commodity, will do to these things. It's crazy. Just because of fluctuations in the price of oil, they went from 71 to 48. At least those are the prices that I bought at, my best and worst. And so right now it's at 62. And so I'm underwater on my worst purchase price, just like I am with Chevron. This is worth noting. Very, very volatile. And so from a yield on cost standpoint, Shell pays $3.76 a year in dividends. And so on my best purchase price, my yield on cost is a 7.76. On my worst purchase price, it's a 5.24. And the starting yield on cost right now is a 6. Not bad. And so the way I look at Shell is it's actually, even in this market, kind of a reasonable starting yield, as is Chevron. With the price of oil at $75, I actually think these stocks probably could have rallied a bit more. That being said, I'm not buying here because what I've learned over the years, again, is I have enough exposure to these stocks and I am only going to buy these stocks going forward other than reinvesting dividends at bargain basement prices. So why do I like Shell? They have a high dividend. It's one of these companies, kind of like Ford. It has a high dividend. It probably isn't going to grow much, if at all, but I'm locking in a high dividend, and I locked in a 7.76% on my best purchase price during the oil price crisis, and so that's a great yield on cost. Now, something else I like. During the oil crisis, everyone expected Shell to cut the dividend. They're like, this dividend's going to be cut. I think they were honestly this close. They were so close to cutting that thing. They didn't cut the dividend. I love that about these guys. And so that was awesome. They held strong through the toughest of times. The other thing I like is it's a global entity. So as you all know, I like to own stocks that are both US based and internationally based. And I also like US companies that have big international exposure. I'm a global investor. I like exposure to the entire world. And with Shell obviously being a Dutch company, I like the fact that I have exposure to a company that is not a US-based company. And so it's just something that adds a little bit of a layer of diversification to my overall portfolio. So I like that about them. And one of the other things worth noting is the debt here is pretty big. And so of the three, if I just say something I don't like about Shell, boy, and this is why I'm so perplexed as to, or I guess perplexed, but also just in awe of the fact that they didn't cut the dividend is they took on a major acquisition. They bought this company BG. This is a big old acquisition, and they did this during the peak of the oil crisis, and so it was the worst timing to make that acquisition. But anyways, it's a big acquisition. They did it. The debt at this company is $80 billion. So of the three, actually, they have the largest amount of debt, and so it's just something to watch out with Shell. Financially speaking, I think they're fine. I think as long as the oil price stays at $75 or thereabout, these guys are fine. What I would like to see happen over time is I would like to see them pay off that debt, because it is a high amount of debt. But I like them because they pay me a ton of cash flow. So moving on, the third one is BP. I've covered this actually in another video, so I'll link in the description below. Just quick refresher though, my best purchase price was $28.77. My worst purchase price was $40. It's at $42.21 now. So thankfully on this one, I'm doing fine. I'm above ground on even my worst purchase price. I'm doing well there. My yield on cost, my worst purchase price is an 8.55%. Awesome yield on cost. On my worst purchase price, it's a 6.15%. Again, pretty good yield on cost. And so this is a company that I bought. I knew this company has its issues. I knew they're recovering from a tragedy with the Horizon, Deepwater Horizon issue. And so I bought this company knowing that I was getting into kind of a mess. And I was breaking some of my own rules because they had to cut the dividend at certain points during their the issues they faced with Deepwater. These guys got hit hard. First they had Deepwater. After that, they had the price of oil going down to $35. And so they're dealt a pretty difficult hand. They got through it. They're a company that is probably operating a lot better now post both of those issues, and especially the Deepwater tragedy. I hope they learned a lot from that and have improved their operations. Anyways, what do I like? High dividend, low growth rate on the dividend. I think there might be some growth ahead, but what I would say is lower growth, but kind of like Ford, locking in a good dividend with these guys, and that's why I bought 8.55% yield on cost. I love that at my best purchase price. And what else? It was a deep value. One of the reasons I like this one is just when I bought it, I feel like it was a deep value. I don't do a lot of deep value investing. I tend to buy stocks. They're more just your classical dividend growth stocks, but sometimes I do deep value. I've covered a few of these on my YouTube channel. I'll link to some of them in the description below. There's some deep value stocks I'm buying now, stocks that everyone hates. And this certainly fell into that bucket. It's one of those companies that just everyone hated. And so I took notice of it and I ended up buying some shares. And when someone hates a stock, by the way, it's actually a positive for me. I tend to like that. The debt at this company is $60 billion. They've certainly racked up a lot of debt. They had to just cleaning up the mess. And so over time, I would like to see the debt get paid down. But these two companies, Royal Dutch Shell, BP, I view them as a bit more risky. I view them more as just get them to lock in the dividend. I don't see a ton of growth or opportunity. I hope they prove me wrong, though, and I think Royal Dutch Shell may prove me wrong, because maybe that BG acquisition in the long term will drive some growth. Time will tell. But certainly Chevron, I look at it as more of a pristine company. This is more of a kind of Class A company over time. And I'd be curious what all of you think out there. Do you invest in the oil sector? Do you own oil companies? Which ones do you like? Which ones do you not like? These just happen to be the three that I own. But again, it's only 5.5% of my portfolio by dollar amount. But I'm certainly glad to have that exposure to the oil industry. And so again, the key points here, in my opinion, is oil right now. It has recovered quite a bit. These stocks are doing better again. They're rebounding, and it will just be interesting to see what happens. Is oil going to go down again? If it does at some point, if there's another huge drop in the price of oil, I will probably take my opportunity to average in again. And quite frankly, this time, where will I be allocating my next dollar if I do put more money in oil? It'll probably be to Chevron. It's probably going to just go in towards the bucket of quality. At the end of the day, I want the best quality, and that's what I'm seeing with Chevron. But I'm certainly happy that I own RDSA and BP as well. So all three solid players. within my personal stock portfolio. And so before I leave today, another thug life moment. I want to share with all of you how a thug can save some money. So I started doing these boards like this on the cardboard. I did them a few videos ago and started doing them. It didn't seem like people minded, and I was surprised about that. I love you guys. I thank you guys for that, for bearing with me here. These whiteboards that I was using from Office Depot, the paper ones, I ran out of the paper, started using the cardboard on the back. And the reason I did that is these papers, it's expensive. I don't want to use a whiteboard because there's too much glare with the lighting equipment. Anyways, started using cardboard, ran out of the cardboard that was on back of those flip charts that I was using. And so anyways, my wife and I, we order a lot of things online. We're real busy. We have 2 kids. And so Costco, for example, we got boxes. We have boxes coming in every week from all kinds of places. And so right before this video, I went outside. I used this Costco box and I just cut it up into pieces. And I used one of the pieces for this board here. It saves money. And more than anything, look, I can go out and buy more paper. I haven't had time. It honestly comes down more to time than money. Time is more valuable than money, way more valuable, but it's also symbolic, and it's symbolic because this is a channel about dividend growth investing. And when it comes to dividend growth investing, it comes hand in hand with the frugal lifestyle. I need to be better at being frugal. I want to challenge everyone out there in the community to be frugal. This is a small way I can be frugal. And oftentimes frugalness, it comes with doing good things for the environment. So rather than wasting a net new piece of paper, this box got one more use out of it before it gets recycled. And so I thought that was pretty cool. I'll give you guys another example. Today, what did I do for lunch? Did I go out, eat a fancy meal? I was tempted. I was actually kind of hungry. It's funny. I got a question once, Ian, you look kind of skinny. Are you eating enough food? Are you saving too much money for dividends? And well, today what I did for lunch, and I do this a lot of days, I like to be healthy, by the way. I'm an athlete. I ran a half marathon last weekend, came in under 2 hours. I was really proud of that. You want to learn more about that? I'll link below. Check out my Instagram. But also I try to eat really well, and I do try to save money. And so I ate lunch at home. I had a peanut butter sandwich. And what I also did is I went to Starbucks. And by the way, I own stock in Starbucks. I love you, Starbucks. But how did I eat at Starbucks? I'll tell you. When I make purchases on my credit card, and I have a business credit card, and on the credit card it does the points, and I redeem the points for these Starbucks gift cards. So check that out, all these gift cards here. And what's great about these gift cards is then I can use them at Starbucks when I'm not paying any money out of pocket, other than using my points to pay for my snack or my lunch. And so I went to Starbucks, I got a beverage, I got a croissant, came home later, got a peanut butter sandwich. Yeah, probably too many carbs, not enough protein. I will make up for it at dinner by eating some meat. But at the end of the day, this is what the thug life is about. This is what being frugal is about. This is about what dividend investing is about. And so you'll go out on the internet, you'll see people who are financial experts that may have a really fancy car, a Lamborghini or a Ferrari. The reason I'm doing this is, one, I want to save some money, but also it's symbolic, and it's symbolic of this community. I want to illustrate a contrarian approach, and the contrarian approach is there's nothing wrong, even if you have a huge portfolio worth a lot of money, or you're just getting started, taking small actions to being frugal and scrappy, such as using the cardboard box. All right, everyone. So before I leave today, just a friendly disclaimer. Today's video is not investment advice. I'm not a licensed investment advisor. Today's video is just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult a licensed financial advisor first. Literally just sharing my personal journey here on YouTube for fun and entertainment. Also, in terms of full disclosure, I own the stocks listed today. I'm long on those stocks. I am long. I own Chevron, ticker symbol CVX, Royal Dutch Shell, ticker symbol RDSA, and BP, ticker symbol BP. And I cannot forget Starbucks, ticker symbol SBUX. I own those stocks in my personal stock portfolio. Also, speaking of Starbucks, we're going to be meeting up at the Starbucks Reserve in San Francisco, first ever PPC Ian meetup. We've now selected a date and a time and a location as well. Check out all in the description below if you want to learn more. I will share some information there. We would love to see you there. at the first ever meetup for our community to talk about investing for dividends and cash flow. Thank you so much for watching, everyone. If you want to support this channel, you enjoyed this video, part 3 of my 3-part oil series, please give it a like, thumbs up, comment. All of that means the world to me. It's the best way you can support me. There is no membership course here. The channel, what you see is what you get. I'm putting all of my best work, all of my best effort here on YouTube. And so I thank everyone for acknowledging that and for supporting the channel. It means the world to me. I love you guys. I will see you all in the next dividend investing video.